Ladies and gentlemen, good day and welcome to Q2 FY2024 results held for Agro Food Limited conference call hosted by Anand Rathi Shares and Stock Brokers. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. I now hand the conference over to Mr. Ajay Thakur. Thank you, and over to you, sir.
Hi everyone, I welcome you all to Agro Foods Q2 FY24 results conference call hosted by Anand Rathi Shares and Stock Brokers. From the management side, we have with us Mr. Sachin Gopal, Managing Director, and Mr. KP Srinivas, CFO. Now, without wasting much of our time, I would like to hand over the call to Mr. Sachin Gopal for his opening comments and followed by Q&A session. Over to you, sir.
Thank you, Ajay, and good afternoon, everybody. Thank you for taking the time out to join us today. We'll follow our standard process where we'll walk you through the presentation. We have had one or two comments saying that, we might be running shy in terms of, we need more time in terms of Q&A. So I'll request Ajay at about 5 minutes to 3. Ajay, if you could just let us know if we need to, if we need to give another 10 minutes or something like that for more questions. Okay. All right. So I assume that all of you have got access to the presentation that we've hosted on our website and lodged in as well with the regulator. So if I could request you, please, we can go straight to page 4. Okay. Page 4 of the presentation. Overall, I would say it was a soft quarter for us. We did not have any foods growth relative to prior year, and this is below our expectation. And we saw strong margins in staples. So we'll walk you through and deconstruct what exactly is in the business, and therefore, what are the actions we are taking and what do we expect. So to start with, soft quarter with no foods growth, most likely due to unusual phasing by quarter in prior year. Quarter 2 last year for foods was higher than quarter 3 by about 7%, which is very different from the pre-COVID time, right? So there is some amount of, I would say, ups and downs in our basis. That doesn't mean that the growth is what we want. The answer is no. But the trend between quarter 1, quarter 2, quarter 3 was different last year as compared to the pre-COVID years. So overall, we think it's probably better to look at 6-month data rather than 3 months data, right? Okay, because the longer the data points, the more accurate, the greater the accuracy that you have. And year-to-date food volume growth, therefore, is about 6%, which is about 4% in value. This is probably more representative of current growth rates. Now, we clearly need to get into double digits very quickly because, our CAGR is in the region of 18 to 19% in foods. So we'll talk you through what are the actions that are currently underway. In terms of gross contribution, this was actually quite good. Net sales less RMPN. This came out to be about 40% for the total company. And foods is still now pretty much back at the 46% level, which is the level that we've had historically. That's a good gross contribution because, as you know, in the food business, the best in class today is Nestle, which is hovers between 48 and 52%, depending on the quarter. And that includes infant nutrition and coffee. So clearly 46, 48, 49, these are kind of very, very good gross contribution figures to look at. They indicate that the core of our P&L is right. Now we have to see how to manage our expenses within that in terms of manufacturing, supply chain, SG&A. The strong GC improved our gross margin, as we reported, by about 500 basis points. So this moved up from about 19% to 24%, which generated an incremental 4.5 crores. And this incremental gross margin, we largely invested in A&P across 4 categories. This was also the first quarter ever that we actually had advertising being invested in all the 4 categories of ready-to-cook, spreads, breakfast cereals, and chocolates. And it's kind of a sort of vision or a painting of the future where we see ourselves as a multi-category, multi-product line company which is able to support advertising profitably across categories. The increase in other expenses is largely due to higher freight and travel, right? And quarter 2 profit before tax and PAT are therefore lower than prior year because we did earn margin, but we also invested a significant amount in A&P, right? And therefore is lower. And year-to-date PBT and profit after tax are higher, significantly higher than prior year. But that's obviously because quarter 1 of last year was a very low base because of the commodity price inflation that we saw. So We will today's presentation, we will not spend so much time on margin. We will talk to you about margin and EBITDA progression when we talk to you in the November analyst call, if you remember our meeting. If you remember last year, we had talked to you about how are we going to get to 1,000 crores of foods, and this year we're going to spend a little more time on what is the roadmap to getting to that 15 to 20% EBITDA margin, which we feel structurally we have because we have a good gross contribution. But we'll walk you through what are the actions in that when we meet in November. Okay. So if I could request you to go to page 6 now. On the ready-to-cook category, this is the core of our business, right? And as you can see, in quarter 2 of this year, we had a volume was almost flat at about 1% and value was down 4%. On a year-to-date basis, this low single-digit revenue growth, or what this comprises of is a low single-digit revenue growth in RTC popcorn, which is driven by a mid-single-digit volume growth both in instant popcorn and some pricing in microwave popcorn. The reason why I am deconstructing this for you is that obviously this is the largest part of our business and we need to see this growing at about 8 to 10% in terms of our overall growth algorithm. And the good news is that instant popcorn, which is the mass product, is already in that 5-6% range in terms of volume growth, right? So that means we are coming out of COVID, right? And we are, therefore, if we keep doing all that we are doing, just continuing to invest behind it, expanding distribution, we should get back to that 8 to 10% level, right? And in microwave popcorn, volumes are actually flattish, but we have some pricing, so that is giving, the combined is that in ready-to-cook popcorn, we're getting a low single-digit revenue growth. What has happened, however, is that we spent a lot of energy in the last 12 months because our popcorn business was not growing, right? And we spent a lot of energy to put it back, and we diverted a lot of retail demo resources, so on and so forth, and away from non-popcorn businesses. That was a conscious choice that we had. One of the consequences of that is that if you look at point number 5 in this chart, or point number 4, you can see the non-popcorn businesses are currently trailing prior year by about 49%. That includes basically sweet corn and pasta. These are the two big ones, right? And so now that we've got the popcorn business kind of going towards our growth algorithm, we are going to start increasing focus on that part of the business as well. Meanwhile, coming to point number 2, we are investing steady levels of media, and you will see that in the competitive spend charts behind instant popcorn. Microwave popcorn will also benefit from the launch of the pop-up box. This is already in market in some parts of the country and will be fully national probably in about 10-15 days, right? And it's an interesting concept. It's basically it increases the convenience of the microwave popcorn of the consumption of microwave popcorn. It's not game changing that it will suddenly change and everybody will move from a microwave bag to a microwave box. But because we also have a tub, but the tub has certain supply chain challenges which this pop-up box helps to address, right? So it is certainly going to be new news for the category, and to that extent it will help our overall performance. And in terms of the non-popcorn business, we are once again putting efforts this winter or coming ongoing festive season and winter behind these products, and we expect to be able to turn that around. I will later in this presentation, we have a chart on historically how our different product categories behaved as we built them, and you'll see therefore that these businesses tend to go a little up and down in the early stages till we get our full business model right for that category. We've also told you that we'll be launching plant-based and cocoa-based products in quarter 3. This is on schedule, and in the next probably couple of weeks, we will be rolling out these products. And when we meet in November, you'll actually be able to touch and feel them in the meeting. So that's it on the ready-to-cook category. Overall headline, base of the category, which is instant popcorn, now at mid-single-digit volume growth. Revenue lower because we had taken pricing up last year. We did some corrections as the commodity prices softened because we wanted it to be correctly priced to be able to secure our ongoing volume growth objectives. And basically the category being dragged down by the non-popcorn business. Okay. If I could request you please to go to page 7. Overall, on the ready-to-eat category, all looking good, getting a growth of about 23-24% in volume and value. It's really ready-to-eat popcorn which is driving the category growth, and across pack sizes and across channels. Sweet snacks continue to make very good progress. Year-to-date sweet share of RT is at about 8% compared to 4%. If you recall, in the back half of last year, it gone to 11. Obviously, because as winter comes in and festive seasons come in, the sweet part has a greater advantage, and we expect to continue to make progress on this one. We are also rolling out gift packs to leverage our sweet portfolio. So that has starting this Diwali, and it's excuse me, which is in the market now. We are also strengthening our rupees 5 portfolio, and I want to make a mention of this because there are large parts of consumers in this country who really, for whom 5 rupees is the main price point for snacks, and therefore it was very important for us to create a snacks portfolio between snacks, breakfast cereals and chocolates, which would enable us to have a profitable 5 rupees portfolio. So that part I think is more or less under development right now, but we made a lot of progress in the last couple of months. And as we move, therefore, from, we have a coverage of a little under 500,000 stores. As we move from 500,000 to 1 million stores, we expect this to be a very critical driver. It could be new areas. It could also be new stores within our current coverage, right, within the current beat. But either way, a strong, robust 5 rupees portfolio is important. That doesn't mean we want to be a 5 rupees company, but we do need it to be to support the expansion coverage plan. And we will continue to leverage the scale of savory and the margin of sweet to create a profitable sweet and salty snacks business. Overall, the category is doing well, both in volume. Margin improvement is also very, very significant in this category as we get a better portfolio and a more profitable portfolio. So all looking good here. No specific actions that we need to talk to you about. In terms of spreads and dips, as we indicated to you probably 2 or 3 quarters ago, that we were possibly losing some share in this category because the volumes were not coming as we wanted them. We've taken the actions here over the last I would say 3 to 4 months, right? We've launched a 300-gram pack at 99 rupees, which is very good. That's consistent with the strategy that we followed in the large 924 grams for 1 kg pack, where we really, I would say, dominate the category. And we are now going to do the same thing with this 300-gram pack in the mid-size pack, and therefore any loss of share that we may have had, 100, 200, 300 basis points, whatever the number might be, we think we should be able to address that, and then again get this also in a nice growth mode, the mid-size pack segment. The rollout of the new 10 rupees blister pack is underway. As we mentioned to you, this is the first, I think, blister pack in peanut butter outside of North America. It's the first time any company or country is doing it, and acceptance is very good. On this month, for example, in terms of transactions, it's probably in our general trade because it's still to get fully listed in the modern trade. That process is underway. We probably have more transaction on the blister pack than we have in any of the larger packs in the general trade. So that means, and it's only 2-3 months in the market. So this will do very well for the business because it will enable us to get new consumers. Some people may stay with it. Some people may come to a bigger pack. But this is a very, very strong acceptance. And as you can see from the photograph on this chart, it's located on the counter very often. It's close to chocolates. So it's really perfect. It's a perfect vehicle for us to drive consumer acquisition and bring new consumers and grow the category. You would see from the comparative charts that our significant spending competitor has spent about 140 crores so far. This is obviously on rack rate, so if you take whatever discounts they have, you'll have to reduce it by that much, whatever that number might be, right? But it's a fairly significant spend by any circumstances. Now we had, as you know, a few options. What do we deal with it when we have such a large corporation coming in what is relatively a small category and willing to spend that much money? We could have tried to compete with them on advertising dollars, but we chose not to do that because that would have meant a lot of money and wasted shareholder money, right? And so we chose to compete on price. So we have taken some hit on margins on peanut butter, right? But the strategy is paying off. For the last 3 years, our CAGR on the peanut butter volume is 17%, right? Now, as you know, if any business grows by 16% per annum, CAGR, in 4 years that business doubles, right? So now this is up to last year. Obviously, this year is not coming at the same rate as 17%. Right now, it's -2. Let's we'll get it into positive space. But if it's not 17, the 4-year CAGR could be 16 or 15, right? But so bottom line is our exit volume 4 years after the launch by HUL in peanut butter will be about 2x of our pre-launch volume. In other words, whatever was our volume when we launched, when they launched their peanut butter, our volume post 4 years will be double of that, right? So that puts us in a happy situation, right? Because after that, these spends are clearly not sustainable, right? Because on a 140 crore spend, our estimate is they've got revenues of about 20 crores, maybe 22, 23, but not much more than that, right? So it's not paying. It's not paying, and it cannot pay for them. The strategy cannot pay for them. We are in a very, very strong situation, right? We are already there in the 1 kg pack. Many of their packs, I think, have been delisted in some of the customers. And we are not meaning the large pack. I think it's not customers across, but maybe some stores. So I think we are a very, very powerful situation, right? And once we get this share back in the mid-size pack and we expand with the small pack, we are in good situation. As and when the spending high level of spending stops, it will give us a pricing opportunity, which we will then apply to volumes which are double of what they were 4 years ago. So some impact on short-term margin, but overall strategically absolutely the right thing to do. We continue to work on the protein segment for peanut butter. We are working with gin, so on and so forth. Chocolate spreads, we're getting our act together. I'm going to refer more to chocolate spreads when we come to the category of new businesses, on the over packs and dips. And we will certainly although we have not really cracked the dips business so far, but I think there are clear indicators that some of the things that we are doing on the peanut butter business, if applied to dips, will actually give us a good position. Okay. With that, I would request you to please go to page 9, breakfast cereals. Here again, like the ready-to-eat snacks, business going well, 41% growth, 45% growth. Pop center-filled cereals clearly powering the growth for ATFL, and we are benefiting from the RTE snack supply chain, right? From a supply side, actually, since the supply side is common, right, because of facilities, I would say when we think of scale, probably we've always said we need about a 200 odd crore business to get a good margin in a category. Probably in this case, when we look at cereals, we could combine cereals with snacks, and that would be the desired level from a scalability perspective. Our rewired architecture for Pop shells has been well accepted, and total cereals distribution is therefore reflecting steady growth. We have 4 months of continued investment behind Pops, which is now completed, June to September, and we are launching 2 new products in quarter 3 and quarter 4, which will complete our portfolio in breakfast cereals. So we believe that we can continue delivering strong category volume growth and achieve segment leadership in center-filled cereals. As you know, we have Kellogg's there in center-filled cereals, and we also have Tata Soulful. But we believe we are uniquely placed in this category. We have a distributed supply chain. We have 3 plants across the country, so our freight is good, our product is outstanding, and frankly, very difficult to compete with. So we expect to continue to see good growth in the category. Page 10, chocolate. So chocolate looking a little lower than what we would have liked it to be, but we did have to test out to see how far we can go without advertising support. So we had mentioned this to you, if you recall, 2 quarters or 3 quarters ago. And so Duo continues to steadily gain distribution. We started therefore media. We could see that there was some tapering without the advertising. So we started media investment in August, the month of August, to support the task of consumer acquisition. Rollout of the 5 rupees pack is also underway to further expand distribution. We will build on this, and we are working to increase our share of the 1,000 crore gifting market with the Moments pack, which is priced at 100 rupees. So gifting is a big part of chocolates. Depending on what data point you use, the number of the share of the gifting market at consumer price will be valued at anywhere between 800 and 1,000 or 1,100 crores. It doesn't really matter for us. These are large enough numbers for us if we get a reasonable share of it. So we are I think close. We've launched our most aggressive gift pack so far at 100 rupees, and I think it should do well. At the time that we launched, actually there was only Cadbury's had a 100 rupees gift pack, and I believe they've also moved the pricing right now. So they may revisit their pricing depending on looking at our move. But I think it's a nice pack, and we'll test it out. Obviously, gifting, the mastering the gifting business takes time, but I'm sure we'll get there. And we are on track for capacity expansion in FY24, which is capable of supplying volume for a 100 crore business plus. That doesn't mean we're going to 100 crores next year, but we wanted to have the capacity for that type so that it gives us some flexibility. Chocolates is a difficult product to make, right? As I've mentioned to you very often, a single insect in a plant lays 250 eggs over a period of 4 days. If one of them lands in your product, you've got a challenge. That is why it's a highly profitable business. You can survey and access through MCA the the P&L statements of Mondelez, of Hershey's and Mars, you will see it's a category with 60% gross contribution. 60% gross contribution, 58 to 60 is very much par for the course. So everybody would like to do it, but to be actually able to build the manufacturing capabilities and to build a supply chain which can handle that is incredibly difficult. I think we've done a large part of it, and we know that we need to be very, very careful because, we have a lot of things at stake in the future on this category because, if we want to drive our gross contribution from 46% to 48 to 50%, then chocolate has to play a very significant role on that. So we just need to be very careful as we progress this, but in good shape overall. Okay. If I could request you to go to chart 11. Now, this is a chart which is useful and may help to answer a lot of questions as you think about new categories. Okay. What we've done is the last year in each category is FY23. Okay. So year 15 for peanut butter is FY23. Year 12 for RT popcorn is FY23. Year 5 for breakfast cereals is FY23. And year 4 for chocolates is FY23. Now you can work backwards and arrive at whichever is the year. Okay. We didn't want to give precise data in volumes in terms of revenues, right? Because that would be that I think would not be good from a shareholder standpoint. But we wanted to give you a perspective on how long it's taking for us to build new businesses. This is a question actually that is often asked to companies by the street because everybody wants to know. I saw a recent interview with one of our investors that they asked somebody from Tata Soulful this question. They say, but you are building these businesses, but they're very small. And she correctly answered the question. She said, look, these businesses are small today, but we need to have multiple businesses which are going to grow so that when the time for investment is right, we can invest behind this business. And she's absolutely spot on, right? So if you see here, in the case of peanut butter, we crossed the 15 crore mark somewhere around year 7 and year 8, right? And you can see in the early years it's probably under 10 crores. You can, approximately, okay? We don't need to know the precise number. Oddly, in RT popcorn also it happened around the same time. It happened after about 8 years, we crossed the turnover of 15 crores. And if you see the prior 5-6 years, the first few years, it was hovering. Now, what is that number? I mean, I won't be able to recall exactly. Well, let's say in the region of 4 crores, 3 crores, 5 crores, something like that. And somebody once asked me this question, I remember on Chocolate Fest. They said, Sachin, but this is such a small business, what are we doing with it? The answer is that we need to continue to manage these small businesses, refine it, address the product issues that we are having. It could be anything. It could be in recipe, it could be fat, it could be sugar, it could be ingredients, right? It takes time to figure out businesses, right? They don't come out of an Excel worksheet with a linear formula applied, right? That is why the CAGR is the CAGR, it has a mixture of many things, right? So you can see here, we crossed the 15 crore mark in RT popcorn around the 8th year. And in breakfast cereals, it looks like we've crossed the 15 crore mark in about 5 years. And in chocolates, looks like we crossed it in about 4 years, right? So overall, historically, we were doing 15 crores in about 7 to 8 years, and now we're doing it in about 4 to 5 years. Now come to the 50 crore mark. If you look at peanut butter, as per this chart, we crossed it or reached it probably around year 11, right? And if you look at RT popcorn, also we reached it about the same time, year 11, year 12, right? So what this means is that each of the new businesses that we are building up, we're building faster. The earlier ones took us, if it took us 50 crores to reach, if it took us 11 to 12 years to reach 50 crores, in the case of peanut butter and popcorn, we certainly look like we're going to do a lot faster when it comes to breakfast cereals and chocolates, right? Part of that could be due to the fact that our distribution reach is now much wider, right? At the time when we launched peanut butter, our coverage was probably less than 100,000 stores, right? Today, we're at about 500,000 stores. Part of it also could be that our bandwidth, our manufacturing bandwidth, portfolio bandwidth is far greater today than what it was, 10 or 15 years ago, right? So overall, these trends are looking good. Having said that, they definitely need to be much faster because as our revenue grows, to have an incremental growth in our revenue, we need the new products to grow faster and faster, right? In other words, if we are at 15 crores we are doing in year 5 today, or 4 to 5, we should probably be able to do it in 2 to 3 crores. But having said that, 2 to 3 years, right? Okay. But having said that, it has to be done profitably, right? So if I show you some examples going forward, money is not necessarily the answer, right? So if you look at our competitor in peanut butter, they've spent 140 crores already, right? And probably that turnover is in the region of 20-25 crores. That's our estimate. Maybe it's right, maybe it's wrong. We don't have access to Nielsen data, right? And so it's is it by our model a profitable business? The answer is no, right? Similarly, if you look at one of our other competitors in breakfast cereals, they spent 40 crores already, right? And after a couple of years, the business is still probably in the region of 5-10 crores. So we certainly don't want to have an unprofitable business, because we need to build our 15% foods EBITDA margin business, right? And we're building it from scratch. Okay, but we need to do it faster. So the good news is the newer businesses are growing much faster than the older businesses did, and obviously we don't have to be satisfied with it, and we should seek to do this even faster. But this will also help to answer that chocolate spreads question, right, which was asked to me some quarters ago, which is yes. Some of these businesses are going to be at 3-4 crores, or if you look at pasta, we got to a 7-8% share of category in the stores that we were, but we had to change our resources and put them behind popcorn. So these businesses are going to be initially at small levels. We'll gradually get the business model right, and then we have to wait for those opportunities, and those opportunities come. You can see in peanut butter, the opportunity came suddenly in year 9. Boom, there was a huge jump. If you look at ready-to-eat popcorn, the opportunity came between year 10 and year 12, right? So there is an old, I think, Chinese saying in this, that the opportunity will come, but you have to be prepared for that opportunity. You should have done all your homework and be ready. And that's exactly what, how we are working to be ready. And then in time, we will have multiple businesses which will be touching 15-20 crores. But the good news is we won't have to then acquire money and spend money to buy businesses to drive. We would have already, those trees, saplings would have been planted, and there'll be smaller trees by then and ready for A&P support. Okay. I hope that has helped to answer many of your questions on new products. I request you to go to page 12. Total staples volume is flat to prior year, supported by mass staples and adjacencies. Rollout on almonds, oats and almond continues. We also did some rollout of honey, but we had some product issues, so we held it back, and we just regrouping, and we'll put that out. These adjacencies of oats and almonds support both increased efficiencies in procurement and the health of our distributor network, right? And we have significantly mitigated the impact of lower edible oil prices on total ATFL and distributor revenue. Distributor revenue is important for us. One of our investors asked us the question, they say, but you said that you will exit mass staples or bring it down to about 5%. It is in the region of 5, 6, 7% of our business, right? But we do need to ensure that our distributor health is important, because in India, the most difficult thing is to build up a distribution infrastructure, and you need to manage it very carefully, because that is the future of the company. Okay. All right. So I would request you now to go to page 14 of the presentation. Snacks competitive spends. You can see here we are spending steadily about 1 crore a month, right? And therefore we are spending in that 9-10 crore region. Last year also we spent about 9. The year before that about 10. There is one interesting data point that's coming out from this chart. If you look below the yellow diamond level, right, in this chart, Bonitos, Tuyam, Balaji, Bikaji, Haldiram, Pipo, lot of zeros, right? And even somebody like Tuyam, who used to spend a lot more money, very little money right now. So this is a trend that we are seeing in multiple categories, right? And I'm not sure what is the reason for this, right? But it is clear that basically the smallest players, I think, in each segment are not spending the way that they used to do. What could be the reason for that? Over time, I'm sure we'll better understand. But there is some messaging which is here. But overall, from our side, we have continued to spend at the rate of 1 crore per month. All right. If I could request you to go to page 15, you can see competitive spends here. Obviously, the spend is dominated by HUL with Kisan Jams and Kisan Peanut Butter. They continue to spend at a very aggressive spend. We continue to have steady spends at much lower level. But again, here, across segments, lower spend, smaller players are less visible. So if you look below, let's say, the Dabur Honey level, you'll see it's a sea of zeros. There is 114 million, 1.4 crores, which Hershey spent in April. Otherwise, everybody's off. right? So there's clearly some stress in the system, and we will, as I said, we'll seek to understand this better. In breakfast cereals, primary spending continues to be by Kellogg's, but we have obviously started our spending in June this year. And, we spent about 2 crores. The September figure is not here, but we spent another 50 lakhs there, right? Nestle has moved their advertising investment. They spent 40 crores in total, but they moved their investment from Cocoa Crunch, which I think is the brand they use in Southeast Asia, to Munch, which is a chocolate brand. So presumably that is to try and get some benefit of the Munch brand, right? And we'll see how this goes. Okay, but overall, I think the primary spender still in this category remains Kellogg's, and we will continue to invest at our levels, to be appropriate. Okay. In chocolates, competitive spend primarily dominated by Mondelez by far the leader in this category. We have started investment behind Duo, and again across segments within chocolates also smaller players are less visible, right? So if you look at the spends by people like Hershey's, if you look at by even to an extent Ferrero, if you look at Mars, definitely spend levels are lower rates. You see a lot more zeros there, right? And including when you look at the last 2 rows, which is ITC. So let's see. As I said, some messaging there, which is indicative. At least at this stage, you can see people are not spending that much. Why they are not spending that much is something that we'll seek to understand. All right. In edible oils, pretty much this quarter, at least on zero spending by the premium edible oil share. We were already at zero, but Marico also now at zero as per this chart. And, compared to 100% a decade ago. So when we told you in earlier years that, look, this whole premium edible oil business is not a great category, and that is why we want to build out the foods business. Many of you told us that, we don't really agree. But the proof of the pudding is in the eating today. When a category has zero share of spending, then the answer is in your face, right? Bottom line, not a great category, and I think we did absolutely the right thing to be able to focus on foods. Okay. So overall summary, therefore, year-to-date foods volume growth reduces to 6% due to a soft Q2. All the actions are in place, particularly in ready-to-cook and spread, so that we can get back up to double-digit levels. Gross contribution starts to reach 40% levels for total company, but more importantly, foods is at a historical level of 46%, right? And that's the one that we need to track because, that's the one over time we need to migrate to the 48 to 50% range. Impact of lower edible oil prices partly offset through growth in foods, adjacencies in premium staples, and higher shipments of mass oils. And we're working towards enhancing the foods growth by executing required actions, particularly in ready-to-cook and spreads. Right? So that, I think, completes the overall review by category. You would have already seen the P&L results, which I touched upon, I think, in slide number 4. If you look at the details of the P&Ls, there's some increase in employee benefits, right? But I would say not that significant. Advertising and promotion, certainly we have increased versus prior year. So you can see the impact of that. Like last year for the half year ended 30th September, if you look at this chart, our results is showing 10.92 crores, which is about 11 crores, which has now gone up to about 15 odd crores. Right? So we added about 4 crores, and a lot of that is in this quarter, right? And yes, on a year-to-date basis, profit before tax and profit after tax is up, but we covered that in the quarter, specifically in Q2 it was down. Okay, so I think with that, Ajay, we've completed. Hopefully, we haven't taken 40 to 45 minutes of the total call time. So since we managed it in 35 minutes, I think maybe we can close at 3 o'clock. But Ajay, over to you, and whatever you want to do. Cheers. Thank you.
Okay, we can open the floor for Q&A session.
Okay, fine. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to only use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Dwanil Desai from Turtle Capital. Please go ahead.
Hi, Sachin. Good afternoon. So I have three questions. The first one is, this quarter we have seen a sharp jump in ad spend, and in one of the earlier calls you had indicated that because of the P&L constraint, our ad spend was around 4 to 5%, which eventually we would take it to 7-8% of our food business. So I think we are roughly in that range. So should we expect this kind of 7-8% ad spend to remain? And kind of does it also mean that the incremental gross margin will get plowed back into the ad money? And a question related to that is that if we spend more money on the advertising, does it mean that whatever historical growth that we were having around 17-18% CAGR, will it add to that, or we need to spend this money to kind of get to that 18-20% growth? So that's my first question. Second question is the chart that you have depicted, which was quite very informative as to how many years it takes for the product to go to 15 crore and 50 crores. So in this life cycle of a product, how does it typically work? After a certain critical threshold, do we see any hockey stick effect? And whether that threshold is 50 crore, 100 crore, any thoughts around that, any observations from your experience you can share? And the third question is on oil business. So oil business, we were clocking around 70 crore gross margin on a yearly basis, and we had said that we would want to maintain a number around that. The only quandary that I see there is that, if we are going for maintaining the gross margin, then essentially we become slightly less competitive to our peers, and then we lose volume. Then if we lose volume, then again, getting back that market or shelf space is very difficult. So isn't it a catch-22 situation where it becomes difficult to cling on to a steady state gross margin in a commodity business? So these are the three questions.
Thank you, Anand. They are all awesome questions. I want to compliment you for your thorough understanding of the business. Okay, so well done. And by the way, some of these questions are also what the board of directors asked me like yesterday and day before. So full marks to you, man. Okay, why don't we do one thing? Maybe we'll take it in the order that you gave. See, this, if you look at our year-to-date A&P spend, it is in the region of about 7.5%, if you take 6 months data, okay? For quarter two, it's a little higher, but 6 months is 7.5%. We remain committed to say 7 to 8% is what we require, right? That's the range that we've always given you for the last many years, and it remains our range. Because we will never make an EBITDA margin out of 15%, out of 12-13% A&P business. It's just not possible, okay? And there's enough data. You can look around at other companies. It doesn't work, all right? The underlying assumption is that our P&L should be able to support it, right? So when we talk to you later in November, we'll talk about this, right? Which is that we feel 7 to 8% is a reasonable range for us to support that 18-odd% growth, that CAGR of 18%. So that answers the third part of your first question, right? It is required because remember, as we become larger, the impact of innovation as a percentage of the total is right. Today, when you are a smaller business, you can do an innovation, let's say 5 crores, 10 crores, right? It will make a delta impact, right? But when you are a 2,000 crore business, a 4-5 crore business is not going to make any impact, right? So you are going to need to spend those advertising dollars. Probably over a period of time, our share of business coming from media, which is advertising driven, relative to share of innovation will change. Today it is about 50-50. But we cannot expect that at 2,000 crores or 4,000 crores, it will be 50-50. But that's why we are building up all these other small businesses, which by that time will be 20-30 crores. So they are already advertising grade businesses, right? An example could be chocolate spreads, an example could be pasta, whatever. Okay. The key underlying assumption, however, for us to maintain, or the key risk to our ability to maintain the 7 to 8% is what's happening on edible oil margin. Right? As you can see right now, our edible oil margin is pretty good, right? Okay, and we are definitely, tracking higher probably than that 70-odd crore number, 70 plus minus number that we gave you. But it's a commodity at the end of the day. It's a single commodity, right? So it's going to have challenges. And therefore, wherever we have got, if you look back historically, whenever we had the opportunity, the first thing that we did was we invested behind our brands, right? But that doesn't mean that there are no risks. If edible oil margin comes under pressure, it's possible we may not be able to afford the 8% level or 7.5% level. But let's see. Touch wood, so far, so good, okay? I'll go to question number 3 because that's related, right? On oils, since we are on oils, and then we'll come to that threshold level question. On the volume impact, very much so. Absolutely. This is our exercise on a day-to-day basis that we keep doing, right? Which is, okay, what's the volume impact? How much margin? Because at the end of the day, it's not a market which is only sun-drop oils, right? There's a lot of competitors in the market, right? And as you can see, many of them spend big advertising bucks, right? Of course, they are all the mass oils category, but they're spending money, right? Maybe they don't see themselves as mass, maybe they see themselves also as premium, right? So we have to keep an eye on it, and it's an ever ongoing work in progress, right? I think the only answer to this is for our foods to dominate the total gross margin contribution. Once foods contributes to 75 to 80% of our total gross margin, then I think the impact of that edible oil margin will reduce. So that is the answer to your third question, which is we just need to keep growing the foods, right? Invest behind it, grow distribution, make it 75 to 80% of the business, because that edible oil risk is always going to be there. It's never going to go away, right? Because it is a commodity, okay? And lastly, on your question on threshold, so this is a question actually that Pedro, who's one of our directors from Concall, said. He says, so Sachin, because we had shown the similar chart. Of course, in the board meeting, we had all the detailed numbers, but it is the same chart in a sense. And he said, so, what's the story? What do we expect at 50 crores? What do we expect at 100 crores, 200 crores? And my answer to him was, Pedro, I think, look, at 50 crores, a business starts to become viable. It's no longer losing money, but it's crossed the threshold of, where the company is investing a lot of time and money. The margins start to come through everything. We have, we obviously for the same categories when we were discussing at the board, we had the margin data also, right? So we were looking at from that context. And then, as I've always said, at 200 crores, the businesses are incredibly profitable. Right? At 200 crores, they're incredibly profitable. So our ready-to-cook popcorn business is there, right? Excellent business, a great business. And so 50 crores, I think, is the first milestone where you say, okay, I am now out of the, if you will, the base investment phase. I think I've got my business model right. Everything is working, right? And 200 is where it probably is. It's a great business. And that's why at 1,000 crores, we need to have about, businesses of about 200 crores. Now, for some, we may choose to consolidate. Like I said, on RT and cereals, maybe if I want scale on these two categories, since the plants are common, maybe I'll combine these two for calculating the scale, at 200 crores, and et cetera, et cetera. So there'll be, it won't be as simple as, black and white, but it will be there, right? And, I think that hopefully answers the question. That doesn't mean that from 50 to 200 it's always a smooth ride. On popcorn at one stage we had 40 competitors, right? Like we're right now seeing on peanut butter. We have a competitor who's spending a lot of money. But we've also done our math. We know that so long as our volume is doubling every 4 years, we are okay, because nobody can spend money indefinitely. When the money spending stops, we'll take up the pricing. Our margins will come back to where they were. So I would say, 50 crores the first milestone. 15 crores is another important milestone, because if you remember, many of you have asked me at what level do you start to invest some media behind the product. And 20 crores is the number I've always given you. So if you see, both chocolates and breakfast cereals are heading towards that, it's in that 20-odd crore mark. So that is why we have started investing. We will not be investing in brands at 5 crores, at 10 crores, like chocolate spreads right now. Right? We'll get our business model right, we'll grow them, we'll have a decent distribution, and then we'll evaluate, what is the stage at which media support is required. Okay? I hope that answered many of your questions, but thank you, they were very good. Yeah? Thank you.
Thank you. We have our next question from the line of Vivek Kumar from Bestpal Research and Advisories LLP. Please go ahead.
Thanks, Sachin. I also have 3 questions. First is, our food growth is, as of now, I'm not talking about when we are at 2,000 or 1,000 crores. As of now, is dependent on spreads and ready-to-cook popcorn growth. So, first is, this may be a wrong assumption, but ready-to-cook popcorn, is it because of the COVID days that we are having a small growth, or is it there are some new competitors and we have to, like what we are doing in spread, we are thinking of other things and re-strategizing so that we'll get our growth back? That is my first question on the ready-to-cook popcorn, because if it is because of just COVID growth, and because it's the most distributed product among all our food products, so when will we start seeing a growth? Because food growth is mostly dependent on that also moving the needle. Second is, when will we start having that flywheel that you are trying and you've been explaining for the last 5-6 years of how you are introducing, why you are doing it at 5 crore product, 15 crore, 50 crore, and when do you think will become a company where, I think you slightly answered in the previous answer of that food's gross margins becoming 70-80%, that we'll have a flywheel that will have a continuous, at least the basic growth would be 10-15%, and good times will grow 25-30%. And when will it, and what factors do you think will lead us there? If you can give some picture on how company will look like, should look like for us to have that. So those are my two questions.
Okay. Thank you. Thank you. Yeah, you're spot on. And in fact, this is a comment that Jim, who's our chairman, made yesterday, day before when we were discussing the financials. He said, look, obviously the new categories are going to build up over time, right? But for now, you're very dependent on ready-to-cook on spreads. And where do we go from there? So I'll try and give you a number, okay, if it helps, okay, because I can't give you the exact. But if you look between April 19, so there is a big COVID-based impact here, all right? And then I'll walk you through the conversations of what Jim and I had during COVID. April 19, and you look at today, our ready-to-cook volumes have doubled, okay? So over a 4-year period, we've got a doubling of volumes, which means it's a 16% CAGR, right? Because 16% means you double every 4 years. Now, as COVID hit, most food companies had a choice, right? We were sitting on elevated consumptions, right? And we, therefore, it produced more profit, right? And at that stage, we had a choice, right? Do we allow that profit to flow down to the shareholder, or do we recognize the fact that these are elevated bases and they can come down dramatically if we don't actually expand our consumer base in that period? And for that, reinvestment in advertising and reinvestment in, if you will, distribution, right? Although distribution during COVID was difficult to invest in because, there was so much work from home that obviously we were not in a position to drive that completely. And that's exactly what we did. So Jim and I talked about it and we said, look, I think we're going to invest, right? And a lot of CEOs in North America didn't do that, right? They said, no, we'll allow the profit to flow in, right? But the consequences are clear. We've got a business which is today double of what it was 4 years ago. And by the way, if you look at our competitive spending charts on Act 2, you will see that in FY20, we were at 4.5 crores on Act 2. Go to the snacks page, all right? And in FY19, we had come down to 3.8 crores because there was a lot of pressure, what I was telling Anil just now about the edible oil margin, etc., etc. And we took that advantage and upped the spend to 10.4 crores. If you look at FY21, 10 crores in FY22 and 9 crores in FY23. This, we believe, has enabled us to actually continue to grow, meaning have this CAGR of 16-17%, right? And avoided possible falls in consumption because we were able to expand our consumer base. And our read is that for companies who didn't do that, who didn't invest during COVID, and this is very visible, a lot of examples in North America, the volumes are actually down today, right? So that's why we are very comfortable. That's why I talked about the instant popcorn growth. I said, look, I needed to deconstruct that chart for all of you. That it's not that 5-6%, 8-10% is what we need. So if we just keep investing, we should be okay. We need to understand this for ourselves as well, so that as management we know we're making the right decisions. Okay. Right. On spreads, I think it's a very simple chart explained very simply. You've seen the numbers. You've seen that HUL launch. It's a significant launch, significant investment by somebody to spend 140 crores in a category which is just a few hundred crores, right? And we had to take the best management actions that we could take, which we've taken. I believe they've come out very well. And honestly, if we double our volumes pre their launch, our manufacturing cost structure will be much better. We'll have a good share, and we will be able to therefore take some pricing. When exactly do they stop spending? That's a question I can't answer. I wish I could. All right. Okay. So it could take more time, a lot more time. Let's see how it is. Right. Okay. Right. On your comment on the flywheel, if you will, I think to an extent Anil's question also was in the same space as you also mentioned. I think look, I've always said a meaningful size of category for us is about 200 crores. If each category is worth about 200 crores, I think each one of them is very self-sufficient, right? So multiplied by 5 here in 5 categories, that's 1,000 crores. Now, it won't happen exactly because ready-to-cook is already that much larger, right? Peanut butter and ready-to-eat are also larger than chocolates and breakfast cereals. So we can make projections, but broadly, I think 5 times 200,000 crores is where the whole piece should fit in. At that level, if you assume a 250 odd crore oil business, for example, that means about 80% of our business is foods, right? At 80%, that also ties in with Anil's question that we are much less reliant on the oil business for margin and also for overhead absorption, for SG&A absorption. Okay, so we'll talk more. I think in November when we talk to you about what's the roadmap on EBITDA to get to that 15 to 20% range, which structurally we have a business for that. That's the time we can ask more of these questions. Okay, thank you, Vivek, for asking that. Okay, Akshay, back to you.
Thank you. We have our next question from the line of Bimal Sampath, an individual investor. Please go ahead.
Yeah, good afternoon. Hello.
Good afternoon. We can hear you loud and clear. Yeah. Thank you for your questions.
So I have sent the questions by mail. If you have received them, it will save that much time.
Okay, done. All right. So I'll
have just reply.
Only I think, Mr. Sampath, I'm going to have to be respectful to everybody else on the call. So I'll read out Mr. Sampath's question. Okay,
no, I'll read it out for you.
I'll read it and cover it. Don't worry. It's okay. Thank you. Okay. Chocolates. On seeing the highlights, I find there is practically no growth in this segment. Are we on track with our capex plan? And are we still expecting to get to 100 plus crores? So the answer, I think I covered this. I thought I'd covered it, but obviously I didn't to your expectations. So the answer is
because I put it before the presentation. That's why.
No worry. So obviously, we've got a year-to-date growth of about 20%. We had said earlier that we will see at what level, it just needs advertising support because the business is already there in that 15-20 crore range, and that's why we started advertising. As far as the capacity expansion is concerned, that will take place. That doesn't mean we'll do 100 crores of chocolate sales next year. It just means that we'll have that capacity and then we'll be able to meet the growth effectively. Building out a supply chain does take time, particularly for this complex category. There are lots of people who would like to enter chocolates. Anybody who would like to enter a chocolate with a 60% gross contribution, right? But to make it work is not so easy. It's extremely difficult. Okay, so we just want to make sure that we don't stumble in a hurry, and we are building out the capacity. We may be obviously running in the early stages at lower capacity utilization, but it will allow us that we are never under pressure. We do all the right things, and obviously as we invest more, it's a great category for us. Okay, breakfast cereals growth it's not due to just placement. I think overall the portfolio sees its, there are times there are good and there are bad times in any business. You can see even in those 15-year charts, right? There are good years and there are not so good years, okay? So, the question is, overall, are we on track for those 50 crore, 100 crore levels? And I think the answer is yes. Nachos, yes, certainly the visibility of Nachos is probably less today because we are also focusing on building out the Sacco brand on the mass segment side, right? That enables us to get multiple price points. And also, if you know, you're aware of, we do pay Conagra royalty on the use of the Act 2 brand. So we expect in our mind that there is a certain minimum margin that we would make on anything that is going to be branded Act 2. If not, we are always going to exercise the choice of moving it to Center of Sacco, right? Because, it has to make sense for everybody. It has to make sense for our parents. It has to make sense for us. And in ready to cook, okay. I think the question was, thanks, the Act 2 Nacho is not as visible. Okay. And ready to cook, I think I've already talked about this pasta, sweet corn. You can see from the RT popcorn there, it takes time to build out, but once your business model is cracked, you are through. Okay. And spreads also, I think we are able to match. I think the answer is are we able to match Amul in pricing? The answer is much more. We are very, very strong in terms of relative to Amul. So really, we've talked about what is our strategy to achieve the 20% growth, And on mass staples, I think I covered it in my conversation that we are not moving back to mass staples, but we do need to take care of our distributors' revenues, right? And so that's important for us. Thank you, Mr. Sampath. Okay, Akshay, back to the next person.
Thank you. We have our next question from the line of Sai Kiran, an individual investor. Please go ahead.
Hi, sir. Thanks a lot for some of these detailed questions. Just want to ask you, sir, for the last 10 years, the gross margin of the company has not seen any growth. Rather, it is more or less range bound. I appreciate that the composition of the foods business and the gross margins have moved from 20% to probably around 55-60% now. But as we see in the last 10 years, we have not seen any gross margin growth coming at all. How do you see this if you have to look backwards? And how do you expect this to move for the next 5 years, probably especially on the gross margin growth? That's my question number one. And question number two, if I also look at the operating cash flows, primarily there is a meaningful capex which has gone in for the past 10 years again, primarily building up 7 to 8 plants and then all that stuff. And there is reasonably large CWIP which I can see in FY23 as well. So what is that you have in your mind when you generate the cash flows, and how do you expect these to get utilized for the next, again, maybe 4 to 5 years? Thank you.
Thank you, sir. Okay. Spot on as far as the gross margin is concerned, and we've covered this in our annual report, also in the director's report. I think it's been in the region of about 170, 180 crores thereabout for some years. And the reason is what you said, exactly that, which is that, we've chosen to move away from the edible oil business, right, and to focus our energy on foods because that's a great business. And, that's a business where we can get to a 15 to 20% EBITDA margin. We don't think any oil business can give you a 15 to 20% EBITDA margin. So that's the change in there, right? Now, what will be the trigger for increase? The trigger is really when the dominant share of foods is actually where food starts to dominate the share of gross margin, right? Along with that growth rate, you will automatically get the gross margin. Okay? So, of course, this year also you are seeing gross margin improvement, but a lot of that is also due to oils this year. Probably if I look at the gross margin improvement this year, it's about 2/3 oils and 1/3 foods. So, but over time, obviously, it will have to be more and more foods, and it will be foods. Okay? So, I would say that would be the first answer to your question. On the cash flow, see, we work on assumption that on capex we spend in the region of about 45 crores a year. Okay, right? So that's about the number that we've been spending, and we feel that that's adequate for us. Remember, we've not gone and had a huge capex in 1 year. We spent whatever 500 crores over the last 15 odd years, right? And we built out large plants. We built out 6 facilities. We built out close to 500,000 square feet of plants, put in a lot of categories, right? At a very, very low cost. So now we just see this as continuing at that level. So I would say if you work on a 45 crore capital expenditure every year, probably that's a reasonable number to work with. Okay? Okay, so I think that's it. Thank you, Sai. Thank you for asking the question. Appreciate it. Both very good questions, and things that we also have to keep asking ourselves. At least the gross margin. Thank you. Thank you very much. Okay, Akshay, over to you.
Thank you. Ladies and gentlemen, as there are no further questions from the participant, I now like to hand the conference over to management for closing comments.
Okay, no, thank you, Akshay, and thank you, Ajay, and thank you all for taking the time out. We look forward to talking in more detail when we meet in the end of November in our analyst meet. And I would say, clearly the foods growth is less than we expected, right? We are cognizant of that, and clearly the 2 areas that we are working on and working hard on are the ready to cook and spreads. The others, we think are in good shape. Yeah. Okay, so we'll update you more, not about the quarter in November, but at least about the question on profitability. We'll certainly answer that. Okay, thank you so much. Thank you for joining us. Bye-bye.
Thank you.
On behalf of Anand Rathi Share and Stock Brokers, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.